Some of you may know, but the man that we're looking at right here is Jeremy Lefebvre. He has a YouTube channel called Financial Education. He's a millennial. He's very influential in the investing space. And when I got into investing, he was very influential in how I approach the market, how we think about the market. And so there are some things I disagree with him about. There are some things that I agree with him on, but he's been very successful in the market. He was one of the early people on YouTube to call Tesla. He bought Tesla for pennies on the dollar, and he's made a fortune in Tesla and other stocks. So he recently came out with a video, which was 7 stocks to buy and hold forever. I think the title of the video was something like "Buy these and never sell" or something like that. I will link his video in the description below, but he picked 7 companies to buy and hold forever, and we're going to analyze 6 of those. We're going to exclude Wynn Resorts, mainly because we couldn't find reliable data on some of their metrics here that we value on this channel. So that is on the agenda for today. We're going to look at the inner flame growth scores of these 6 companies. We're going to look at their 5-year performance in the market, and then we're going to look at their safety metrics, and then we're going to look at the inner flame finance safety scores. What we'll do is we'll compute intrinsic values of those companies. We will look at analyst expectations, and then we'll talk about what we think about these companies and how we might invest hypothetical $1,000 here in inner flame finance. So the first company that we have here is Amazon. We all know Amazon. We all know and love Amazon. We shop, we stream, we do everything with Amazon. It's basically the backbone of the internet. The PEG ratio is 1.3. Growth scores based heavily on PEG ratios and forward PEs. And we see a forward PE of 24.4, but a 5-year forward PE at about half that at 12.5. So that means if you buy Amazon today, you're getting it for a 12.5 PE, price to earnings ratio, based on their expected 5-year growth. And what is that 5-year growth, by the way? It's about 18% every single year for the next 5 years. Of course, that's just a projection out to the future. We don't know what they're actually going to do in the future, but based on analysts' expectations and analysis on Amazon, they're expected to grow their bottom line 18% every year for the next 5 years. Now, the 2 numbers that really stand out for Amazon are return on equity and return on invested capital. These are some of the best numbers of any company that we'll see. They have very low debt to equity, coming in at a 0.4. And Amazon over the past 5 years has not done well. So the market's up about 65% in 5 years. However, Amazon is up about half of that at 32.11%. So in the past 5 years, Amazon has massively underperformed the market. So the question is, does Amazon have any room for growth in the future? And if they've been suppressed over the past 5 years, are they going to like maybe spring up and shoot for the moon in the next 5 years? Jeremy seems to think so. Time will tell, and we'll do our analysis in a bit. So the next company up here that Jeremy is bullish on in the long term is Celsius. He often compares Celsius to Monster Energy, which Monster Energy is one of the best performing companies in the past 25 years. They do have a very nice PEG ratio at 0.7. We like to see that under 1. They have some of the best free cash flow yield of any of these companies, only at a 3.4. That's half of the minimum that we like to see of 7, but they are a growth company, so we don't expect that number to be too terribly large. The other standout for this company is, even though they have a forward PE at 21, they have a 5-year forward PE at 6.8. But the thing is they are expecting 86.7% EPS growth every single year for the next 5 years. That is very ambitious. We don't know if they can do that. Time will tell. We will not be using numbers close to 86% when we project their growth out into the future to compute their intrinsic values. But Celsius, over the past 5 years, has doubled the performance of the stock market. They're up about 132% in that time. And so, of course, past performance is not an indicator of future gains. So time will tell what's going to happen to Celsius in the future. Third up on the list is ELF. ELF is a company that Jeremy bought very, very cheap. He sold a bunch of it. He regretted it. ELF came crashing back down, and now there's maybe some room for growth in ELF's future. The 2 numbers that stand out here are the forward PE at 19.5, some of the best of any of these companies that we'll look at, and the free cash flow yield coming in at the best of all 6 companies at a 5.4. Now, ELF is something that's also massively outperformed the market in the past 5 years. They are up about 148% in that time, so that's more than a doubling of your money. And like I said, Jeremy bought this stock when it was down in the well, it might have been even in the single digits when he bought it. So if we look at the max for ELF, I'm pretty sure that Jeremy was buying it when it was like in the 8s, 9s, 10s, and then he sold around here, and he did very well for himself in ELF stock. He's very bullish on it for the future. He thinks that this is one of the best cosmetic brands out there. They're cheap, they're inexpensive, and so they can survive recessions, and they have global dominance, they have global influence, and so this is something that Jeremy is in fact very bullish on in the long term. Number 4 is Meta, and we can see why just looking across this row here. They have some of the best numbers of these 6 numbers. They have the lowest forward PE at 8.4, rather 18.4, which is nice. They have very low debt to equity coming in at 0.4. Return on equity and return on invested capital are in the 20s and 30s. Profit margins very healthy at 30%. Revenue growth 17.5%. 5-year forward PE 10.5. Very, very nice for such a big, dominant tech company. The problem is Meta has really increased their CapEx spending. Recently in the news, they basically said that this whole metaverse build-up that they were building was a giant flop, and they spent a lot of money on that. Now they're spending a lot of money on their AI infrastructure and build-out, and so investors are a little bit worried that companies like Meta are spending too much on AI. Time will tell if that will pay off, if this is a worthwhile investment for Meta. We look at the past 5 years, and this is another company that has outperformed the market. They're double their value over the past 5 years. And one thing that really stood out from Jeremy's videos is he was buying it in this dip. Okay, people were saying that Meta was overvalued, it was undervalued, there was fear in the market. Starting in mid to late 2021, Meta stock starts crashing, crashing, crashing. And this is a company that Jeremy always believed in. He always talked it up, and he influenced a lot of people to buy at these lows right here. And sure enough, after mid to late 2022, you can see that Meta stock was just off to the moon. It blasted up almost to that $800 mark. It's come down a little bit. So we're going to use our projections to see what is Meta actually worth when we compute the intrinsic value in a bit. Number 5 on this list is Nike. He feels that Nike is a very reliable dividend stock. He thinks that it's not fairly priced. He thinks that it's too undervalued, and so he's been very bullish on this stock, even though the stock price has been coming down over the past 5 years. And we can see, first off, of all these companies, this isn't really any sort of growth company at all. It's Nike. They are big, they are dominant, they are global, but they don't really have a lot of room for growth, and that is reflected in their PEG ratio at a 2.1. Their 5-year forward PE, one of the highest of all these companies, second only to ELF so far. And we don't see a lot of revenue growth on the horizon. We do see 13.6 EPS growth. Now, the thing with Nike is they fired their old CEO and they brought in a new guy. And I believe the new CEO, Elliott Hill, is a founder of Nike or was part of the build out of Nike back in the 80s and 90s. So this is somebody that has a lot of value in this company. He's been there and he wants to see Nike survive. And so this is probably why Jeremy is bullish on Nike. Plus, as Jeremy points out, Nike is everywhere. They are on uniforms of your favorite athletes, even though those athletes are sponsored by other people. Nike is just a dominant powerhouse in the athletic apparel space. And we look at Nike over the past 5 years, however, and we see a much different story than what Jeremy might be talking it up. Now, that doesn't mean that it's not going to go up, but Nike has been beaten down 61% over the past 5 years. So you've lost about 60% of your value in Nike stock in that time. Now, this obviously does not include dividends. So if you've been earning dividends this whole time, that's a different story. They do currently pay out about a 3% dividend yield on the stock, but it's something that just keeps going down and down and down. And to use Jeremy's phrasing and terminology, they just can't seem to find a bottom. So we'll look at Nike in a bit. We'll do our own analysis on this company, but this is something that Jeremy has been talking up for quite some time and continues to based on his last video. And finally, the banking app SOFI. SOFI has some really nice numbers in the growth category. They have a PEG ratio of 0.6. That's the best of all these companies. They have the best debt to equity just at a 0.2. That means for every dollar in equity they only have 20 cents in debt. Profit margins pretty healthy at 12%. They are basically a software company, so you would expect those to be higher. Revenue growth and EPS growth, some of the best of these companies. They do have negative free cash flow yield, which gives us a little bit of concern, but their 5-year forward PE coming in at just under 11 is really, really nice. And over the past 5 years, they're a little less than flat. They're down about 6-7% in that time. They did dip down quite a bit. We at Interflame Finance bought quite a bit of SOFI during this time, and it's been off to the races ever since. And we're just sort of holding on our position and chilling and seeing what will happen to this company. So those are the 6 companies that Jeremy is talking up. Now, what we do on this channel is we score these companies from -10 to +10. -10 is the best or rather -10 is the worst company in the world. +10 is the best company in the world. So, and 0 is neutral. So we're aiming for higher than 0. Typically on this channel, we do 5 and up. So first for growth is Nike. Obviously, they are once again a giant company. They are very well established. They're paying a dividend. Not a lot of room for growth in Nike. They're just sort of a stable company at this point. So they get a 1 for growth. Coming in next to SOFI, which is rather surprising, but what's really hurting them is their forward PE and also their negative free cash flow yield. They don't have a lot of return on equity or invested capital either, so these numbers are holding SOFI's numbers down. ELF, as Jeremy calls it, ELF on a shelf. This is a 3.5, so we're getting close to that minimum of 5 mark. And what's really helping ELF is their forward PE and their free cash flow yield, but there are some numbers that are hurting ELF in the end in growth. Now, Amazon comes in at a very surprising 4. I think Jeremy would disagree with this number, and he would say that they would command a higher number, a higher score on the Interflame Finance scoring methodology. Their return on equity and invested capital are really helping their numbers. Their PEG ratio, we'd like to see that a little bit lower, maybe at the 1 mark, but this is a solid company. It's Amazon. They're not going anywhere. They're only getting bigger. And so this is a very strong growth company. And we've featured this company many, many times on this channel. And we always point out that the numbers, the scores that they're getting on this channel are probably lower than they actually deserve. And then coming in second to the top is Celsius at a 4.5. If you want to round that up to a 5, that's fine. PEG ratio, solid. EPS growth, very nice numbers coming in for Celsius. But the strongest growth company is Meta, coming in well over that 5 mark at a 7.5 for growth. And so Meta, they are Facebook, they are Instagram, they are WhatsApp, they are all sorts of different social media companies. They're getting into the virtual reality and the AI space. So Meta, for all these companies, is the best growth company of his 6 companies to buy and hold forever. If you are enjoying this video so far, please like it. That will really help out the channel. And if you want to keep coming back for more analysis of your favorite stocks, and you want to look at scores and intrinsic values, please consider subscribing to the channel so you never miss a video. Now for safety, as we saw, these 6 companies are not really known for safety. You could make maybe the case for Nike, but Nike's just been beaten down about 60% over the past 5 years. So we're going to go through these numbers rather quickly. First up is Amazon. Amazon does not pay any dividend, so therefore they have no dividend growth or years of dividend growth. That's something that we do like to see when it comes to safety numbers, and they're just not there. Celsius, same deal. They're just not there. I do see there's a typo here, so let me just fix this column real quick. Here we go. It was we had the percent on the 5-year forward PE. It's not a percent, it's just a ratio. It's just a number. So anyway, the PE ratio for Celsius not looking good at 152. It is coming down on that very, very strong growth in the 80% range at 6.8. So there's this huge contrast between the current PE and the expected PE based on today's numbers in 5 years. And again, that's based on very, very high levels of growth that we are not going to use that. But we want to be conservative in our estimates. So Celsius, probably not a safety company by any stretch of the imagination. Same with ELF. They don't pay a dividend. They don't have the best free cash flow yield, although it's the best of all 6 of these companies. ELF, probably not a great safety company. Meta is a dividend payer. They've grown their dividends for 2 consecutive years at about a 3.7% rate. That's basically in line with inflation, but only a 0.4% dividend yield, so nothing really too special. But across the board, very strong numbers for Meta in the safety category. Nike is the best dividend payer of these 6 companies. They have a dividend yield of 3.0%. They have grown their dividends for 24 consecutive years, so they are so incredibly close to that very coveted dividend aristocrat title. And so we don't expect Nike to cut their dividend, at least for the next year, because they probably want that title. And just to note that their payout ratio is about 84%. That is getting up there. We'd like to see that number come down quite a bit. Dividend growth, however, is 5.2% every year in recent years. And so that's a nice number. That's outpacing inflation. That's up there. It's nice. Nike, kind of a decent safety stock. And then SOFI, also not a very comfortable safety stock either. And so the worst company for safety is SOFI in that regard at a negative 2.9. We don't see negative scores very often on this channel, but SOFI not very safe as far as these numbers are concerned. ELF on a shelf, as Jeremy would say, coming in just over a 0 at 0.7. Celsius also not looking too good with that very high PE ratio of 152. Amazon coming in at a 2.9. You could make the argument that Amazon is just a behemoth of a company, and so they probably deserve a higher safety score as well. You could make that argument. We're just going with the numbers that we have here of 2.9. Nike coming in at a 4.3, and just at that 5 mark is Meta coming in at a 5. We see the numbers across their row. Meta is a solid company and also not just the best growth company, but the best safety company of these 6. Have a decent idea as to what the scoring is for these companies, how good of companies they are based on growth and safety. But we want to make sure that we're not just looking at decent companies or quality companies. We want to make sure that we're getting them at a good price. And so what we're going to do for all 6 of these companies is compute what's called the intrinsic value. You can see here I have the worksheet up for SOFI. There are 4 different intrinsic value calculators that you can go down into the description of this video, and you can find the 4 links that help you compute the PE ratio, the dividend discount model, the discounted cash flow model, and the Graham valuation. Now, we are only going to use the appropriate models for the companies that we look at. So, for example, SOFI here, since they had negative free cash flow yield, we're not going to use the discounted cash flow model. They don't pay a dividend, so we're not going to use the dividend discount model. And Graham's valuation is usually pretty bearish for growth companies like SOFI. And so we're only using the PE ratios model. But something like Nike, we would use the dividend discount model, probably Graham valuation as well. So check out the links in the description below, and you can build out these spreadsheets yourself. And then you can have these very important tools for any investor in their toolbox. Intrinsic value is absolutely necessary for any investor because you don't want to buy things at good prices. You want to make sure you're getting them at good values, okay? So for example, SOFI here, they are currently trading for $17 per share. We think at Interflame Finance that there is actually worth $20 per share. That gives us about a 17.7% margin of safety for this company, meaning we can be about 17, 18% off on our projections and predictions and still make money on this trade. So check out the links in the description below to get your intrinsic value calculators built out so you can do this for these 6 companies or any companies that you'd like. Now we're going to do things a little bit different on this video because we do have very different stocks. These 6 companies are quite different. And so what we're going to do first is value safety less than growth. And so we can see here that we're giving growth a weight of 8 and safety a weight of 2, meaning we're going to emphasize growth over safety. So SOFI has a growth score of 2.5 and a safety score of negative 2.9. But if we give 80% of the score to growth, we get an average score of 1.42. So as we just saw on the intrinsic value calculator page, the current stock price is $17 per share. Intrinsically, we think that they're worth $20 per share. That gives us a 17% margin of safety for SOFI. And analysts are a little bit more bullish than we are. We say $20 per share. The average consensus on Wall Street is $25 to $27. That's between a 54 and 65% increase in the stock price over the next year. The most bullish analysts coming in with a $37 price target. That's quite high, almost double what we think here at Interflame Finance. The overall consensus for SOFI is it's a buy. There are 3 analysts that say strong buy, 3 say buy, 8 say hold, 2 say sell, and 0 say strong sell. So SOFI, little mixed. There are analysts that think that it's basically trading for fair value, and there are some that say it's going to more than double. So let us know in the comments below what you think of SOFI stock. Next up is Nike with an average score of 1.66. They're currently trading for $53 per share, and we think they should be trading for $55. So basically fair value. There's only a 3% margin of safety in there for Nike. And we are on the bearish side of analysts as well. We say $55 per share, and the average consensus on Wall Street is about $75 per share. That would be about a 41% increase in the stock price over the next year. Now, the overall consensus on Wall Street is that Nike is a buy, with one analyst even saying that this should be a $100 per share company. And so there are analysts out there that are quite bullish still on Nike. There are 8 strong buys out there. There are 9 buys. There are 8 holds, and there are no sells or strong sells for Nike. So some disagreement between Interflame Finance and Wall Street. We are probably just going to hold the shares that we have and collect these dividends. But we would love to see the stock go up to $100 per share. Time will tell. We feel better investments in the market, so we're going to focus our capital elsewhere. And so that brings us to number 3, elf on a shelf, as Jeremy would say, a 2.94 average score. They are currently trading for $68 per share. We think the intrinsic value is $55. So that means that they are overpriced, that you would be paying a 23% margin of safety for ELF. So our $55 price target is way too low for analysts on Wall Street. That is lower than even the lowest estimate at $85 per share. The overall consensus is that ELF will probably double almost in the next year. The average stock price coming in at about a $130 price target. That's a 92% increase when there's even a 151% increase predicted on Wall Street. This is a strong buy for analysts. There are 9 strong buys. There are 4 buys, 3 holds, no sells, and no strong sells. So once again, Wall Street and Interflame Finance disagree. Let us know in the comments below what you think about e.l.f. beauty products. Do you think that this is really a $130 stock, or do you think it's going to stay where it's at or even go lower? Let us know what you think. Stock number 4 of Jeremy's picks is Amazon. They are currently trading for $207 per share. We think that they should be trading for $240. That gives us a 14% margin of safety for Amazon. And $240 comes in almost in line with analysts. It's a little bit lower than the average consensus of about $278. Wall Street is predicting between a 34 and a 42% increase in the stock price over the next year. And there are bears out there for Amazon saying that no, it's actually going to fall about 15.5% and go down to $175 per share. And then there are bulls saying it's going to go up to $325. So the overall consensus for Amazon is that this is a strong buy. There are 20 analysts that come out saying strong buy, 23 say buy, 2 say hold, and nobody's in the sell or strong sell category for Amazon. Number 5 comes in Celsius with an emphasis on growth. This is a 3.88 score on the Interflame Finance scoring methodology. The current stock price is $37 per share. We think intrinsically it should be trading for $55. That gives us a very nice 33% margin of safety for Celsius. So our $55 price target is between the low and the average coming in at about $66 to $70 per share. That would be over an 80% increase in the stock price in the next year. The high estimate coming in more than double at $77 per share. You would get a 108% increase in Celsius. Now, there are 11 analysts that say that this is a strong buy. There are 3 that say buy, 2 say hold, one says sell, and nobody says strong sell. So, as a matter of fact, before I made this video, I was talking to somebody, talking to a friend, and she was talking about how much she loves her Celsius and how much she loves her Alani. And if you know anything about the company Celsius, they also own Alani. And so she was talking about how much she loves those beverages. And, you see people walking around with these cans all over the place. It's a very popular beverage that seems to have come out of nowhere. And Jeremy's been very bullish on this company as a whole, and he still is. He believes that this is a buy and hold forever stock. And we would agree, maybe not buy and hold forever, but we do think that there is significant upside into this company. And so let us know in the comments what you think about Celsius. And finally, the best company overall, coming in with an average score of 7, is Meta. Current stock price is $593, and we think that this should be a $660 company that gives us a 10% margin of safety overall. So $660, very, very low, on the low end of analyst expectations. The average consensus for Meta coming in at $838 per share. That would be about a 41 to 43% increase in the stock price. There are analysts out there that say that this should be well over $1,000 to $1,144. That would be about a 93% increase in the stock price. Now, 20 analysts out there are saying that this is a strong buy, 18 say buy, 4 say hold, 0 sell, and 0 strong sell for Meta. So there you have it, folks. That is a emphasis on growth. Now what we're going to do is we're going to look at an emphasis on safety. So if you blinked, you missed it, but some of these companies kind of rearrange themselves. We do now see that SOFI has an average score that is negative, so probably something to steer away from, even though they have a 17% margin of safety. Not a good safety score. So if this company hits hard economic times, if there's some sort of recession, if there's some sort of global contagion in the stock market, then SOFI may not be the safest place to hide out. Meta still comes in at the top, but Nike coming in with an average score now of 3.64 because of that safety score on the higher end of 4.3, kind of moved them up the list a little tiny bit. Now, this would be a great place to remind you that nothing that we say on this channel is financial advice. We are not telling you to buy, hold, or sell anything in your personal portfolio. Always do your own research and always do your own due diligence when buying stocks. But the thing is, if we wanted to invest $1,000 hypothetically at Interflame Finance, how would we do so? Well, based on safety scores, we would put nothing into SOFI. It is technically a buy. We're getting it at a 15% discount. The intrinsic value is $20 per share. So if we wanted a 15% discount from that, we would buy it $17 per share, and we would buy much more heavily at $13 if we wanted to buy it. But because of that negative average score right now, at least for safety, we might avoid it. Same thing for e.l.f. Now, it's not a buy or a heavy buy. Anytime it's going to be under $47 per share, we would buy e.l.f. Anytime it's under $36 per share, we would buy much more heavily. That would be a 35% discount in the stock price based on the intrinsic value of $55 per share. Now, Celsius is the first company where we have a decent score, not the best score of 2.02 for safety, 33% margin of safety. So we would put about 37.8% of our capital into Celsius. It is currently a buy. It's under that 15% mark. It's currently trading for $37 per share. We think it should be bought at 47 or lower. And if you really wanted to buy heavy, look for 36 and lower, and it's almost at that point. So if there's another red day in the market and Celsius gets brought down even more, this might be something to consider buying in our Interflame portfolios. Now, Amazon comes in about 24.4% of our $1,000 into Amazon. It's not in the buy or buy heavy signal, but it is a quality company. And again, these scores of 4 and 2.9 really don't do this company justice. We are getting a 14% margin of safety for a very decent company. So we would put $244 into Amazon. Nike would only get $57. It's a decent safety company with a 4.3, but we're basically trading for fair value, 3% margin of safety. So we would put money into them, but not a whole lot, only 5.7% of our $1,000. And finally, we would put $321 into Meta. That's based on their best scoring company, 5.5, and a margin of safety at 10%. We would throw about 32.1% into Meta. But note that they are not in the buy or buy heavy marks. These companies are trading basically fair value, except for Celsius and SOFI. So with an emphasis on growth over safety, we go back to the original list that we had of scores, and we see now that all of a sudden we're buying SOFI. It has an average score of 1.42, so not the best. There's a 17% margin of safety, which is pretty nice. And so if we absolutely had to invest in these 6 companies, we would put $84 into SoFi over 1,000. We would put $16 into Nike, $186 into Amazon, and we would buy much more heavily for Celsius and Meta. Celsius gets about 45% of our money because they have a fantastic growth score of 4.5, and they are trading very, very cheap, 33% margin of safety. Meta, we get about 25% of our money. They have the best growth score. They have the best safety score, but only a 10% margin of safety. So they are closing in on that fair value mark. We would buy much more aggressively at 561 and incredibly aggressively if Meta ever got down to $429. So there you have it, folks. Thanks for joining us. Go ahead and check out Jeremy's channel. He's got 2 channels, actually. He's got Financial Education, and he's got Jeremy Lefebvre Makes Money. He taught me a lot, and I learned a lot, and I owe him a lot for what I do in the stock market and how I approach things. Again, like I said, he and I differ in a lot of ways, and there are many, many things I don't agree with and that he says, but a lot of things I do agree with, and he and I are basically on the same wavelength when it comes to investing. So again, if you got anything out of this video, please like it. That really helps out the channel. Feel free to subscribe so you can keep coming back for more videos, more analysis on stocks and intrinsic values. And always do your own research and your own due diligence when buying, holding, or selling any stock in your portfolio. We appreciate you being here. Tell your friends, tell your family, and tell your mother-in-law all about the Interflame Finance methodology and channel. We love serving you. We love growing out the family, and we'll see you in the next video.